Welcome back. So, let us continue from where we left off in the last lecture, but before that a quick recap about the concept of systematic and unsystematic risk, which is a very important issue in the context of the single index model and the CAPM, which we are going to discuss in today's lecture. So, let us start with the expression for the variance of an n security portfolio, the standard expression for the variance of the n security portfolio, which is given in equation number 1 here on this slide. Now, if now I consider a portfolio comprising of equally weighted securities, n securities equally weighted, then I can write x 1 is equal to x 2 is equal to 1 by n, and the above expression simplifies to the expression number 2 that is given here at the bottom of your slide. Now, this expression 2 that I have here can be modified or can be rewritten in a slightly different form, which makes it amenable to future manipulations, algebraic manipulations. I write it in the form that is given in equation number 3. What I have done is simply I have taken a prefactor of 1 upon n, and then within the round bracket, the second round bracket, I have summed up all the variances and divided by n. Similarly, I have taken a prefactor n minus 1 upon n in the second term, and I have summed all the covariances over all the securities I equal to 1 to n, j equal to 1 to n, or j equal to 1 to n, and k equal to 1 to n rather. And I have divided the sum of the variances, the sum of all the variances by n into n minus 1. Of course, out of these two, sigma I j will always be equal to sigma j I. So, we have n into n minus 1 divided by 2 distinct covariances, although the total number of covariances will be n into n minus 1, but pairs of variances sigma I j and sigma j I will be equal to each other. So, let me repeat what we have here in the first in the second round bracket here of the first term, we have the sum of all the individual variances divided by the total number of securities, and the second term we have the sum of all the covariances divided by the number of covariances. So, the first term or the first expression, that is summation sigma I square divided by n, in some sense gives us the average variance per security over the portfolio of securities, and the second term, that is double summation j k sigma j k divided by n into n minus 1, gives us in some sense the average covariance over every pair of securities constituting the portfolio. So, that is how the equation has been written in the next equation, that is, let us call it equation number 4. Sigma bar I square is sigma bar j square is the average variance over the set of securities constituting the portfolio, and sigma bar j k is the average covariance over the pair of securities, any pair of securities constituting the portfolio. Now, if I take the limit n tending to infinity, what I get is the first term tends to 0. Why? Because sigma j square bar would be a finite number, and if you divide it by n, you end up with the limit in the limiting case, the value tending to 0. When n tends to infinity. However, the second term, that is the covariance term, does not go to 0 completely. If you find that one part of the covariance term, that is covered by minus 1 upon n sigma bar j k, will go to 0 as n tends to infinity. However, the first term, that is n upon n sigma bar j k, will not go to 0, that will be a residual left over when we take the limit n tending to infinity, and this is what sigma bar j k represents the systematic risk of the portfolio, and the first term, that is arising out of the variances, the intrinsic variances of the securities, represents the unsystematic risk. So, the outcome of this, as I explained in the earlier lectures also, is that firstly the total variance of a portfolio cannot be made 0, it will tend to a finite non-zero value even in the case when we have a massive diversification. When we have infinite diversification, the total risk will tend to a finite non-zero risk. The amount of risk that can be diversified away arises from the intrinsic variances of the securities and the amount of risk that cannot be diversified away, that is retained or that survives the diversification, arises from correlations between the securities. So, this is the outcome of the general mean variance framework. Let us now see how this approach gets modified in the domain of the single index model. So, in the single index model, we can write the variance of a single security in terms of two parts. One part that is related or that arises from the market risk or the market randomness, that is captured by beta I square sigma m square, and the other part that is intrinsic to the security, that is captured by the second term, that is sigma E I square, which is the residual variance. So, that is how I have written here the second equation on the slide, and then I do some algebraic simplifications, nothing more than this, and I can write this in the form of equation number 5, which I write here. This is equation number 5, and this is how we can write this particular equation, which represents the total variance of a portfolio in the context of single index model or within the domain of the single index model. Now, let us look at a equally weighted n security portfolio. Let us look at a equally weighted n security portfolio. Then x I will be equal to 1 upon n for all I, and when we make this substitution, we arrive at the expression which is given as in equation number, let me call it equation number 6. So, if you look at equation number 6, the first term which I underline now is what? It is the summation of all the betas of all the securities that constitute the portfolio divided by the number of securities. So, in some sense it represents the average beta per security of the security set that form the portfolio. Similarly, when you sum the same thing over beta j, you will get again the same expression, that is the average beta over the set of securities constituting the portfolios. So, what we have as the complete first term is sigma m square beta bar I that is sigma m square beta bar I whole squared. And what about the second term? In the second term, if you look at this, what happens to the second term? It is the sum of all the residual variances of all the securities divided by the number of securities, and that is in some sense the average residual variance over the set of securities that constitutes the portfolio. That is the expression that is within the square brackets, but there is a prefactor of 1 by n also. So, when I take the limit n tending to infinity, the expression that is within the square bracket together with the prefactor will approach 0. Why? Because the expression within the square bracket is finite, and when you are dividing by n and taking the limit n tending to infinity, this expression will go to 0, and what we will be left with is the expression that survives is the first expression, and that can be written in the form beta I bar square sigma m square. So, in other words, what we are getting at is that this expression, the first expression, that is beta I bar sigma m square, represents the systematic risk, and the residual risk that is captured in the single index model by the random error term represents the unsystematic risk. So, that is one inference. The second inference is to look at the comparison between what we had in the earlier slide. Let me go back to it. Sigma bar j k, which was the expression that we arrived at in the context of the general mean variance framework, where no assumption as to the pattern of risk return trade off was made, as is the case in the single index model. So, we have the systematic risk being captured by the covariances or the average covariances of the portfolio. However, in the case of the single index model, we find the expression is slightly different, as is captured by beta bar I square sigma m square. In other words, the presumption or the assumption of the single index model that any mutual interaction between the securities arises only on account of, or any co-movement between securities arises only account of their relationship of individual, the relationship of individual securities with the market portfolio, and there is no direct interaction between the securities I and j, that is vindicated by this expression which is the outcome of the single index model for systematic risk. You can see here that we have beta bar I square sigma m square. So, there is this expression clearly shows that the systematic risk is only on account of the relationship or the interaction or the systematic relationship between the security I and the market, and there is no direct interaction between any pair of securities I and j. That is indeed the premise of the single index model. So, that is vindicated by this expression as well. Let us now move forward. This inferences I have already discussed in an earlier lecture, and I highlighted them a few minutes back as well. So, now we move over to the capital asset pricing model. Now, in the mean variance framework, of Markowitz that we have discussed in a lot of detail in the earlier lectures, we had made two fundamental assumptions. Number one, that expected return is a function of risk, and number two, risk is measurable by standard deviation. Number one, expected return is a function of risk, and number two, risk is measurable by standard deviation. These were fundamental assumptions, basic assumptions of the Markowitz mean variance model. William Sharp asked the question, what are the implications for asset prices if everyone adopts the Markowitz framework? If all the players in the market, all the investors adopt the Markowitz framework for the optimization of their portfolios, then what would be the implications for the market prices? You see, the point is, as far as the Markowitz theory is concerned, it is investor centric in the sense that everything has been developed from the perspective of the investor, how the investor should manage his portfolio, how he should distribute the various assets at his command or at his disposal to arrive at an optimal mix of the various securities or the various assets. So, now William Sharp looks at it from a different perspective. He looks at it from the perspective of collective wisdom. He looks at it from the perspective of the market. If everybody in the market was to adopt the Markowitz model, what would be the implication on the market prices of the various assets that are being traded in the market and that are being used by the constituents of the market in order to arrive at their optimal portfolios? How will the market respond to that? How would the market prices adjust themselves in a situation where the market may be deemed to be in equilibrium? So, he reasons that in equilibrium all assets must be held by someone, and that means what? That means that in order that the market be in equilibrium, the expected return on each asset, this is fundamental, the market return on each asset, the expected market return rather on each asset must be such that investors collectively decide to hold exactly the supply of shares of the asset. And this is the most important part of this particular proposition pronounced by William Sharp, that what he says is that if everybody does the Markowitz homework, if everybody follows the Markowitz framework for designing his optimal investment policy, and how the prices of the various assets would react. In other words, what would be the risk return representation in the market, and because you see, at the end of the day, it is necessary that if the market is in equilibrium, the demand supply must be matched. Demand supply of each asset must be matched. So, if the demand supply of each asset must be matched, then what would be the implications on the returns on each securities? The returns on each securities has to adjust themselves in such a way that the demand supply is matched and every asset that is available in the market is held by somebody. That was the line of reasoning that was adopted by William Sharp in deriving his capital asset pricing model. So, having given this background to you, why did William Sharp come up with these questions? Let us try to understand that. The issue was whether standalone risk, that is the standard deviation that is measured by the standard deviation, is an appropriate measure of risk, number one, and number two, does market price standalone risk? In other words, if a security has higher standalone risk, will it command a higher expected return? That was the question. These were two questions which William Sharpe went on to investigate. Number one, whether standalone risk is the appropriate measure of risk. Number two, does market price standalone risk? In other words, does the expected return flow in tandem with standalone risk? Is the standalone risk the sole determinant of the expected return on a particular security? So, if you take a higher standalone risk, are you entitled or are you allowed by the market to obtain higher expected returns? Please note the word expected. I have discussed this in an earlier lecture also. We are talking about expected returns. Expected returns means returns which are to be realized in future, and if there is a higher risk attached to higher expected returns, then that implies that the realizability or the probability of realization of those returns is also reduced because the risk is more. So, while the expected return may be higher, the possibility or probability of the realizability of that expected return may be reduced. That is the concept of risk and return. So, anyway, coming back to this, these were the questions that William Sharpe went on to investigate, whether standalone risk is the correct measure of risk, and number two, does market price standalone risk. Let us try to understand why these questions arose in the mind of William Sharpe. Let us take an example to motivate the discussion. Consider two shares A and B with standalone risk, that is standard deviation or variance, you may call it, you may use either. Sigma A is equal to sigma B is equal to 6%. Consider two shares A and B with standalone risk sigma A is equal to sigma B is equal to 6%. Let the shares be so priced because they are having the same standalone risk, and on the premise that the market prices standalone risk, they should command the same expected returns. So, the shares would be priced so that expected returns in both the securities is the same. Let us assume that the expected return is 10% for A and 10% for B, because they are having the same standalone risk, and we are working on the premise that standalone risk is the correct measure of risk and the market prices standalone risk. Now, so far so good, there is no issue so far. Now, let us form a portfolio comprising of A and B in equal proportions, and let us assume that the correlation coefficient between A and B is 0.50. Let us assume that the correlation between A and B is 0.50, that is rho A B is equal to 0.50. Then what we find is, because the portfolio A and B comprises of two securities having the same expected returns, any linear combination of the two securities would still give me the same return, that is 10%. And so, if we are taking half of A and half of B, then we still have R P is equal to 10%. But what about sigma P? If we work out the sigma P using the standard formula for the variance of a pair of securities using x A is equal to x B, what we find is using x A is equal to x B is equal to 1 by 2, what we find is that sigma P is equal to 5.2%, and this is very interesting. What does it convey? It conveys that sigma P, the combined portfolio of A and B, we have done just nothing. We have simply diversified from one security to taking two securities. The two securities are identical in terms of standalone risk and in terms of expected returns. We have combined them to form a 50-50 portfolio, and we find that for no rationale whatsoever, the risk of the combination is less than the risk of either A or the risk of B, and this is very interesting. And yet the anomaly is that, notwithstanding the fact that the risk of A B, let us call the combined portfolio P, the risk of the combined portfolio P is lower, and yet it is giving you the same level of return, same level of expected return as A or B. This is obviously a contradiction. If the market is pricing standalone risk, then because the portfolio P has a lower risk, it should get a lower expected return, but it does not happen, and the math does not agree with this. The math says that the return on the portfolio P will also be the same as that on security A and security B, notwithstanding the fact that the portfolio P has a lower level of standalone risk or aggregate risk. So, there was some issue, there was some problem, and this is what motivated William Sharpe to get into these issues in depth, to investigate these issues, and he came up with the capital asset pricing model. So, if the market was to price the sigma risk, that standalone risk, the standard deviation risk, then the portfolio P should necessarily provide a lower expected return than A and B, because it has a lower risk in terms of lower sigma. So, that was the basic issue. Market cannot be in equilibrium in this situation, which is manifest by using the concept of standalone risk as a measure of risk in the market. So, that is what motivated the development of the CAPM model. Now, where does the problem lie in so far as the math is concerned? The problem lies in the fact that while expected return on a portfolio is the weighted average of returns of its constituents, as we all know that the expected return scales according to the weights of the constituent securities in the portfolio. RP or ERP or RP bar is equal to summation of XI RI bar. So, that means what? That means there is linear scaling. The expected return on a portfolio is equal to the weighted average of the expected return of its constituents. However, the standard deviation does not scale that way. That is the problem. The variance does not scale that way. The variance also depends on the correlations or the covariances that exist between the various securities that form the portfolio. The variance does not simply scale as the weights of the constituent securities in the portfolio. So, this difference in the behavior, in the aggregate behavior of expected return and variance or standard deviation is the root cause of the math that is behind this problem. Okay. So, let us now go with the CAPM assumptions. Let us quickly run through the various assumptions that are made by the capital asset pricing model. They are quite radical. Let me tell you at the outset. Nevertheless, the test of a model does not really lie on the assumptions that form the model, but on how good that model fits reality, and it is observed that the CAPM model fits reality to a reasonably good extent, and that is why it has become so very popular that it forms the cornerstone of most of the evaluation exercises that we do in corporate financial management. So, that being the case, let us quickly run through the assumptions and let us not get carried away by the unrealness of these assumptions, because as I reiterate, the test of a model is not in terms of the assumption it makes, but in terms of how good it is at describing reality, which the CAPM model seems to be reasonably good. So, the first assumption is there are no transaction costs, there is no cost or friction of buying or selling any asset. Given this size of transaction costs, they are probably of minor importance. So, in any case, transaction costs nowadays, because of the electronic trading and so on, is a very small proportion of the volume or value of transactions, and therefore, they do not form a significant constituent in the analysis. Nevertheless, we assume that there are no transaction costs. Assets are infinitely divisible, that is the second assumption. This means that investors could take any position in an investment regardless of the size of their wealth. So, this is the second assumption. Absence of personal income tax is the third assumption. This means, for example, that the individual is indifferent to the form, whether he gets the return on his investment in the form of dividends, or he gets the return on his investment in the form of capital appreciation. In either case, he is not concerned with the source of the increment or the accretion in wealth, and the income tax does not differentiate between these two sources of returns. Assumption number 4, an individual cannot affect the price of a stock by its buying or selling action. This is similar to the assumption that we make in the context of perfect competition in economics. So, an individual by his own actions cannot influence the various parameters in the market, like the price of an individual security. He cannot by his individual actions influence the price. Nevertheless, although no single investor can affect prices by individual action, investors in total determine the prices by their action. So, it is the collective behavior of or the collective wisdom of all the market players that determines the prices by equating supply to demand. At the equilibrium, the demand and supply of each and every security that is there in the market must be equal, and the interaction of this demand and supply yields a particular or a unique price, which is called the market price. Investors are expected to make decisions solely in terms of expected values and standard deviations of the returns on their portfolio. So, as I mentioned, William Sharpe took the Markowitz model as given and he proceeded therefrom or thereafter. So, the Markowitz model assumes that the investors optimize their portfolios, optimize their holdings on the basis of a mean variance framework. So, that is what this assumption iterates in the context of the capital asset pricing model. Investors are expected to make decisions solely in terms of expected values and standard deviations of returns on their portfolios. Unlimited short sales are allowed and there is no restriction on the use of the proceeds of short sales. Unlimited lending and borrowing at the riskless rate is also allowed. These are fundamental assumptions. Assumption number 8, investors are assumed to be concerned with mean and variance of returns, as I mentioned just now, or prices over a single period, and all investors are assumed to define the relevant period in exactly the same manner. So, all investors define their relevant period in the same manner and they are concerned with the means and variances of the various securities and covariances, of course, over that single period as defined by them uniformly. All investors are assumed to have identical expectations with respect to the necessary inputs to the portfolio decision. This is quite fundamental. This is a very important assumption, that all the estimates that go into the Markowitz framework, that go into the mean variance framework, are estimated by the various constituents of the investor community as the same. So, I repeat this assumption once again, all investors are assumed to have identical expectations with respect to the necessary inputs in the portfolio decision. What are the necessary inputs? The expected values of the various securities that form the feasible set or the set of securities available to form portfolios, then the variances of these securities, and then the covariances between these securities. All the estimates of these securities are assumed to be uniform across the entire investor community. These inputs are expected returns, as I mentioned, the variance of returns and the correlation matrix representing the correlation structure between all pairs of stocks. Then assumption number 10, all assets are marketable. All assets including human capital can be sold and bought in the market. Now, given these assumptions, now we come to the real CAPM. Given these assumptions, but before we do that, a quick recap on how the mean variance optimization was carried out. You can see here in this diagram, which we have handled or which we have observed a number of times earlier. For optimality, what do? We maximize the angle theta, we maximize the angle that the line FP, F is the risk free point or the point representing the risk free rate, P is any arbitrary portfolio, and we maximize the angle that the straight line FP makes with the x axis. So, in other words, we maximize the angle means we maximize tan theta because we are in the first quadrant, and what is tan theta given by? It is given by Rp minus Rf divided by sigma p. You can see from this diagram, and this is a very important quantity in portfolio analysis. It is given a name, and the name that it is given is Sharpe ratio. So, at the end of the day, what we do is, in order to arrive at the optimal portfolio within the mean variance framework, each investor each investor does this exercise. What does he do? He maximizes the Sharpe ratio. So, each investor under the Markowitz framework is concerned with maximization of the Sharpe ratio in order to arrive at the optimal portfolio for of his choice. This is the premise, this is the input that the Markowitz model gives us for the CAPM model. So, improving the Sharpe ratio is the objective of introducing securities or shorting securities in a particular portfolio. Thus, optimization is achieved by maximizing the Sharpe ratio. Now, if the addition of a security as now we talk about the derivation of the CAPM. If the addition of a security S to a portfolio P, we have a portfolio P, we are considering adding a security, adding a small amount of security S to this portfolio P. For this purpose we need money. What we do is we do some riskless borrowing. We do a little bit of riskless borrowing, and using that borrowed amount we buy security S and we add it to our portfolio, which is portfolio P, to arrive at the composite portfolio comprising of P and S, which we call portfolio T. So, if the addition of a security S to a portfolio P increases the Sharpe ratio of the revised portfolio T, then it should be so added. That is the principle, that you are going to maximize the Sharpe ratio. You are, that is what Markowitz tells you, maximize Sharpe ratio, you will arrive at the optimal or the efficient frontier. So, that is what we are doing. We are trying to add security S to our portfolio P by borrowing a certain amount, and by that what we are trying to do is we are trying to improve our Sharpe ratio. Let us assume that a small fraction in value small x of S is added to P by riskless borrowing of equal amount to get portfolio T. So, we add to portfolio P a small amount of security S, which we purchase by borrowing the required amount from a bank at the risk free rate, and we get the portfolio T. Now, the expected return on portfolio T will be the weighted average returns of the portfolio P and the excess return over the cost of borrowing of security S. That is what is given in equation number 1 here. So, R bar T, or expected return on portfolio T, is equal to 1 upon 1 plus x into R bar P plus x into 1 plus x, where x is the small amount that I have used for the investing in security S. So, plus x upon 1 plus x R bar S minus RF. RF is the cost that I have incurred for getting this additional amount of money, small x. So, this is equation number 1. What is sigma t? Now, sigma t is given by this expression, which is the immediate use of the standard formula that we have for a 2 security portfolio, the variance of a 2 security portfolio with the weights 1 upon 1 plus x and x upon 1 plus x. So, please note this risk free borrowing will not contribute to variance in any way, because risk free borrowing has no variance in itself and has no covariance with any other risky asset. So, the fact that we borrow at the risk free rate is not contributing in any way to the variance of the security T, of the portfolio T, that comprises of P and S. And when we simplify this expression, we simplify it a bit. First of all, because x is small, we ignore the second order term here. This second order term in x, that is x square sigma x sigma s square, is ignored because x is taken to be very small, infinitesimal, and then we use the binomial expression and curtail to first order, and we arrive at equation number 2 for the variance of, or the standard deviation of portfolio T. So, the standard deviation of portfolio T is represented by equation number 2 here. Now, what we do is we work out the Sharpe ratio of portfolio T, the new portfolio that we have formed by a combination of portfolio P and security S. So, the outcome, the Sharpe ratio is defined by the excess return to per unit of the standard deviation using the expressions for R bar T that we derived in the earlier slide, equation number 1, and sigma T that we derived in equation number 2, and doing some simplification, what we get is this equation, that is, let us call it equation number 2a. Now if we are to require that the Sharpe ratio of the new portfolio T that we have formed by adding an infinitesimal amount of security S to security P or to portfolio P, what we require is theta, where theta is the Sharpe ratio, what we require is theta T should be greater than theta P. Now, if we use this expression and if we simplify using theta T is equal to the expression given by equation number 2a, and theta P of course is equal to R P or E R P minus R F divided by sigma P, and if we simplify, what we get is the expression that I am underlining. So long as, and what is our decision criterion? Our decision criterion is that so long as theta T is greater than theta P, we will continue adding security S to our portfolio P. So, in other words, so long as R bar S, that is expected value of return of S minus R F, is greater than rho sigma S upon sigma P into R bar P minus R F, we will continue adding security S to the portfolio P to arrive at portfolio T. This is the decision criterion. So long as this process continues, we will do that. So, what will happen in equilibrium? Now please note one more thing. If suppose on analysis what we find is that R bar S minus R F is less than rho sigma S upon sigma P into R bar P minus R F, then what we could do is instead of longing in security S, what we could do, or we could achieve an increase in our Sharpe ratio by shorting S. So, what happens even if this R bar S minus R F is greater than rho sigma S upon sigma P R P minus R F, I will long more and more of security S, borrow at risk free rate and invest more and more in security S, and if this the left hand side is less than the right hand side, what I will do is I will do the reverse process. I will short security S and invest in the risk free asset. So, the bottom line is irrespective of whether this is greater than or less than is, market dynamism will take place and we will not achieve equilibrium. For the purpose of equilibrium, in other words, at equilibrium the left hand side must be equal to the right hand side. It is only then that the equilibrium would be achieved and no more longing or shorting of security S will take place, because you are at the equivalence level. I shall continue from here after the break. Thank you.